Most people hear the words, Spot Bitcoin ETF and assume one of two things. Either it's the next big crypto hype, or something complicated that only Wall Street understands. Quiet wealth doesn't think in either direction. Quiet wealth asks simpler questions. What is this, really? Why does it exist? Who benefits from it? And more importantly, how does it change the long-term financial landscape without the noise? This video isn't about price predictions. It's not about getting rich quickly. And it's not about convincing you to buy anything. It's about understanding what a spot Bitcoin ETF actually is, why it took over a decade to be approved, and why long-term capital tends to move silently, not loudly. Let's begin, calmly. Part 1, Why Bitcoin Needed Translation. Bitcoin was never designed for institutions. It was created to be peer-to-peer, borderless, self-custodied, and independent of banks. That philosophy attracted early adopters. But it also created friction. For the average person and especially for large financial institutions, Bitcoin was hard to access safely. You needed digital wallets, private keys, secure storage, an understanding of exchanges, and the discipline to avoid mistakes that couldn't be reversed. To Wall Street, this wasn't freedom. It was operational risk. Institutions don't dislike innovation. They dislike uncertainty. And for years, Bitcoin lived outside the systems they trust. So instead of forcing institutions to adapt to Bitcoin, the financial system began adapting Bitcoin to itself. That adaptation is called an ETF. Part 2, What an ETF is. Without complexity. An ETF stands for Exchange Traded Fund. Quietly, it's one of the most important financial inventions of the last 50 years. At its core, an ETF is simple, it's a wrapper. Inside that wrapper is an asset or a group of assets. Instead of owning the asset directly, you own shares of the wrapper. ETFs already exist for stocks, bonds, gold, oil, entire markets, entire countries. Most long-term wealth today flows through ETFs without drama. They trade like stocks. They settle through traditional systems. They fit neatly into retirement accounts, pension funds, and institutional portfolios. ETFs don't ask investors to change behavior. They make new assets behave like old ones. That's why they're trusted. Part 3, Spot versus Futures, the quiet difference. Before Spot Bitcoin ETFs, there were Bitcoin Futures ETFs. And this distinction matters. A futures ETF doesn't own Bitcoin. It owns contracts that bet on Bitcoin's future price. That creates rolling costs, tracking errors, complexity, and indirect exposure. It's like tracking the weather by watching forecasts. Instead of stepping outside, a spot Bitcoin ETF is different. It holds real Bitcoin. Actual Bitcoin is purchased and stored by a regulated custodian. Each share of the ETF is backed by Bitcoin sitting quietly in custody. No leverage, no futures contracts, no complex rollovers. Just price exposure tied directly to Bitcoin itself. That's why the word spot matters. Spot means now. Not later. Not promised. Not simulated. Quiet wealth prefers ownership that is clear even if indirect. Part 4, Why it took so long to approve. The question isn't why was a spot Bitcoin ETF approved. The real question is, why did regulators resist it for so long? The answer is not fear. It's structure. Regulators worried about market manipulation, liquidity, custody risk, price discovery, exchange reliability. Bitcoin trades globally, 24/7, across dozens of venues. Traditional markets close. They report centrally. They're surveilled. Bitcoin didn't fit the mold. For years, regulators said the same thing in different words: we don't yet see a market mature enough to protect investors. What changed? Not Bitcoin's ideology. Bitcoin didn't compromise. The infrastructure around it matured: better custody solutions, institutional-grade security, market surveillance agreements, clearer regulatory frameworks. Quiet progress, not loud headlines, made approval possible. That's often how financial legitimacy arrives. Part 5. What a spot Bitcoin ETF is, clearly. Let's define it precisely. A spot Bitcoin ETF is a regulated financial product that trades on traditional stock exchanges and gives investors exposure to Bitcoin's price by holding actual Bitcoin in custody on behalf of shareholders. You don't manage private keys. You don't interact with the blockchain. You don't worry about storage. You simply buy a share. For some, this feels like dilution. For others, it feels like access. Both views can coexist. Quiet Wealth understands that access changes scale. Part 6. Who a spot Bitcoin ETF is for. This product was not designed for early Bitcoin maximalists. It was designed for pension funds, asset managers, family offices, retirement accounts, conservative portfolios needing small exposure. Many institutions are restricted by mandate. They cannot hold self-custodied crypto, use unregulated exchanges, manage private keys. But they can buy ETFs. That single difference unlocks trillions in potential capital. Not overnight. Not emotionally. But gradually. Quiet capital doesn't rush. It allocates. Part 7. What it does not do. A spot Bitcoin ETF does not guarantee profits. Remove volatility. Replace Bitcoin itself. Make Bitcoin safe. Bitcoin remains volatile. It remains cyclical. It remains misunderstood. The ETF doesn't change Bitcoin. It changes who can participate. And participation matters more than narratives. Part 8. Common misunderstandings. Let's address a few quietly. ETFs mean Wall Street controls Bitcoin. No. Bitcoin's network rules remain unchanged. This kills self-custody. No. It offers an alternative, not a replacement. ETFs guarantee mass adoption. No. They allow optional exposure. ETFs remove risk. No asset does. Quiet Wealth respects risk instead of denying it. Part 9. How quiet money moves. Retail investors chase excitement. Institutions chase liquidity, compliance, longevity. They don't tweet. They don't rush. They don't panic. They allocate slowly, rebalance quietly, and hold patiently. The spot Bitcoin ETF is not a signal of hype. It's a signal of infrastructure maturity. That matters more in the long run. Part 10. What this means for the future. The approval of a spot Bitcoin ETF doesn't end the story. It begins a quieter chapter. One where Bitcoin becomes a line item, not a headline. Exposure becomes optional, not extreme. Volatility coexists with legitimacy. This is how assets mature. Not through excitement, but through boring acceptance. And boring is where wealth compounds. Silent perspective. A spot Bitcoin ETF is not a revolution. It's a translation. It translates Bitcoin into a language traditional finance understands. Whether that's good or bad depends on perspective. Quiet Wealth doesn't rush to judge. It observes. It understands. And it positions carefully, because the loudest moves rarely build lasting wealth. The quiet ones do.